And now for opening remarks, I would like to turn the call over to Joseph Mann, partner with Vorys, Sater, Seymour & Pease.
Thank you, Kayla, and welcome everyone. Just want to express our appreciation for all of you taking time out of your afternoon today to join us for this presentation. I just want to start by making a few general comments about qualified opportunity zones and talk a little bit about what we'll be covering over the course of the webinar. Qualified Opportunity Zone Program is a federal income tax program that was enacted as part of overall tax reform at the end of 2017. So it's a program that we've had for a year now, but it's really a program that's still in its infancy. There are a lot of new concepts in this legislation and terminology that just wasn't clear as to how to apply it. And there were some aspects that were left to the Treasury Department to come up with rules. So for much of 2018, taxpayers are just kind of waiting for additional guidance to see actually how to use this new tax incentive. We got guidance in the form of proposed Treasury regulations in October of 2018. And what Treasury decided to do was to kind of take the big questions in chunks. So these proposed regulations address a number of the big outstanding questions, but don't address them all. And Treasury expressed an intent to issue further proposed regulations shortly thereafter. We're still waiting for additional proposed regulations. We're not sure when those will come out, nor are we sure when the original proposed regulations will be finalized. Treasury not only does it have its hands full with kind of issuing guidance on all aspects of federal tax reform, but the government shutdown is certainly not helping things. And in fact, there was a public hearing scheduled for the proposed regulations in January to discuss public comments, and that was canceled because of the shutdown. So, but helpfully, Treasury has said that taxpayers are entitled to rely on the proposed regulations that we have until final regulations are issued. So those regulations should allow many transactions to move forward, but because of the number of remaining issues, the lack of additional guidance will be an impediment to many transactions as well. So, this is the qualified opportunity zone program is in a state of evolution. It's important to, before doing a qualified opportunity zone transaction, to consult your tax advisor as soon as possible, as early as possible, to make certain that you understand the current state of the law at that time, and also to keep up with changes, to keep up with the law during the course of a transaction to make sure that there aren't changes that could impact you. So consistent with this, I just want to point out at the inception, that this presentation is a reflection of our thoughts on the law based on current guidance, and that can and will change as additional guidance is issued. And it's important to consult with the tax advisor if you intend to enter into an opportunity zone transaction. This presentation will not address every nuance and uncertainty in the application of these rules, so it's important to get guidance. So what we're going to cover over the course of the presentation is the federal income tax benefits that are available through this program and the requirements of the Internal Revenue Code. We'll cover some terminology and the transaction structures that are contemplated by these rules. So at this time, I'm going to turn it over to Kelly Bissinger to talk about the purpose of the program.
Good afternoon. I want to echo Joseph's sentiments and welcoming everyone to the webinar. So I'm going to start by speaking about the purpose of the Qualified Opportunity Zone program. And the program was created to encourage the deployment of capital resources into low-income communities through the creation of certain tax benefits intended to help investors reduce or defer their capital gains tax burdens. And it creates, a new potential source of capital for both businesses and real estate investments located in qualified opportunity zones. So qualified opportunity zones are census tracts that have been certified as qualified opportunity zones by the Treasury. When the legislation came out as part of tax reform, it required or provided that each state could nominate qualified census tracts within their states to be certified by the Treasury Department as qualified opportunity zones. The process for the selection and certification of the qualified opportunity zones concluded in June of 2018. And these designations, now that they're set, can't be modified at this point, and at this point are intended to remain in effect through 2028. We've included in the slides a link to the CDFI Fund's website where you can interactively determine whether a project that you're looking at or a business that you're looking at is actually located within a qualified opportunity zone. Other consultants and different parties, if you Google it, have similar mapping devices that you can, put your address in and see whether a particular project is located within a zone. We've included just, some key states such as, Ohio, where there are 320 qualified opportunity zones, and different states have, different mapping functions and other resources that can be helpful in terms of determining whether an area qualifies for the program. So let's talk about what an investor obtains in terms of qualified opportunity zone benefits. So step one, an investor has a capital gain. The capital gain can come from the sale of basically any kind of business or personal property, but the sale has to be to an unrelated person, and we'll describe what an unrelated person is a little bit later in the slides. The proposed regs make it clear that gains taxed at ordinary rates, such as depreciation recaptured, don't qualify. This wasn't clear prior to the promulgation of these regs. So step one, the investor sells their property to an unrelated buyer, and within 180 days of the property sale, the investor takes the cash from the sale and acquires an equity interest in a partnership or a corporation. For this purpose, they could acquire a membership interest in an LLC, but the LLC needs to be treated as a partnership or a corporation for tax purposes. It can't be a disregarded entity. And they acquire the equity in what's called a qualified opportunity fund in exchange for cash in an amount up to the recognized capital gain. And in order to qualify for the tax benefits, the investor retains its equity. And the biggest aspect of this investment is that the investor is going to be able to defer the capital gain until the later of the disposition of its qualified opportunity fund interest, or 12/31/26. But the investor will also receive some additional tax benefits. If the investor holds its equity interest in the qualified opportunity fund for 5 years, it will receive an elimination of 10% of the deferred capital gain And if it holds the investment for an additional 2 years for a total of 7 years, an additional 5% of the capital gain is eliminated. And if the interest is held for 10 years or longer, the appreciation in the value of the qualified opportunity fund interest is eliminated. So let me show everyone what this looks like in terms of all right, I'm going to go back a second. So I think our example is a little bit later in the slides. I'll show an example of the numbers shortly. So the next question in the slides is if an investor has an investment in a qualified opportunity fund with cash that's not the subject of a capital gain, will it be able to qualify for the qualified opportunity fund benefits? And this is a question, we actually tend to get a lot. So let's just say we have an investor that holds publicly traded stock with a value of $1,000 and it has a basis of $500. If the investor sells the stock for $500 or for $1,000 and recognizes $500 of capital gain, and they decide to put all $1,000 as opposed to just the $500 worth of capital gain into the qualified opportunity fund, what happens? So the benefits of the qualified opportunity fund, as illustrated on this slide, only apply to the $500 that's the deferred capital gain. So, after the interest is held for 5 years, $50 of the deferred capital gain is eliminated. An additional $25 of the deferred capital gain is eliminated after 7 years. And, at the 12/31/26 date, the investor will recognize the remaining $425 of capital gain at that point. And then with respect to the remaining $500 from the sale of the stock, there's no elimination of gain, and clearly nothing happens on 12/31/26 with respect to that $500. And take this a step further, when the investor goes to sell its qualified opportunity fund interest on, let's just say July 1st, 2029, let's just say we sold for $3,000. So with respect to that $3,000, half of it is attributable to the capital gain. So that portion is treated as though it has a $1,500 sales price, and $1,000 of the gain is eliminated. But it's not the same result doesn't occur with respect to the $500 that wasn't attributable to the capital gain from the initial sale of the stock. As I alluded earlier, when you go to sell, when you make the initial sale that results in the capital gain, the sale has to be to an unrelated person. And for purposes of qualified opportunity funds, the related party test is a 20% common ownership test with the application of what are called attribution rules. And this is intended, to prevent people from trying to basically create gains by selling to themselves in an effort to avail themselves of the program. Another point I'd make with respect to the qualifying interest is the investor must invest cash in the qualified opportunity fund and receive a qualified opportunity fund interest. These interests can't be acquired through cross purchases.
Yeah, and I would add one point on that. There are principles under federal income tax law where you can have an investor invest cash in an entity for an equity interest, and kind of close in time or in connection with that, the entity can redeem out another investor. And for purposes of federal income tax law, those two transactions could be put together and treated as a cross purchase of an interest. So we don't have any. We have limited specific guidance under the Qualified Opportunity Zone rules that specifically address that, but without rules that made it clear that type of situation is not a problem for Qualified Opportunity Zone purposes, investors should be, I think, careful to avoid a structure that could be characterized as a cross purchase.
Thanks, Joseph. That's helpful insight. So, one of the things that I think was interesting about the proposed regulations was, how they treated the commencement and calculation of the 180-day window with respect to when the capital gain is triggered and when the investment needs to be made. So with respect to a partnership, the 180-day window begins on the day the partnership recognized the capital gain, which is, generally the date of the disposition of the asset giving rise to the capital gain. And the regulations provided that if the partnership doesn't invest all or some portion of the capital gain proceeds in a qualified opportunity fund, then the individual partners could then go ahead and invest with respect to their share of the remaining gain. And the partners window would begin, 180-day window would begin on the last day of the partnership's taxable year. So to illustrate this with dates, let's just say a partnership sold an asset on March 1st, 2018. So the partnership itself would have 180 days to make the qualified opportunity fund investment, which would be August 28th. And then the partners, let's just say the partnership decided not to make some sort of investment, the partners themselves would have, assuming that the partnership's taxable year ended on 12/31, the partners themselves would have a new 180-day window beginning on 12/31. So then, they'd get 180 days into 2019, basically. So, I mean, it basically provides another sort of bite at the apple, although, I'd point out that the period between August 28th and the end of 2018, in my example, the regulations as drafted currently would not allow for an investment to be made. There are similar rules in the regulations that apply to S corps and trusts. The rules with respect to consolidated groups and the members of consolidated groups and how they work remain somewhat unclear at this point. This is one of my favorite slides, and it's a slide that shows the differences between the Qualified Opportunity Zone program benefits and 1031 exchange. So, the first big one is, after tax reform, 1031 exchanges apply just to real estate, whereas the Qualified Opportunity Zone applies to the disposition of, any assets, personal or business property. So it has a wider reach. The second benefit of Qualified Opportunity Zones is that you don't have to trace the sale proceeds. So unlike in a 1031 exchange where you have to put the sale proceeds with a qualified intermediary, here you don't have to do that. And the next benefit I point out is that in addition to providing a deferral of capital gains, the Qualified Opportunity Program also provides, some elimination of capital gains. But on the converse side, a Section 1031, whereas under the Qualified Opportunity Fund program, you can only defer at this point until 12/31/26 your gain. Under the 1031 program, it's basically an indefinite gain deferral. So if you're looking to set up a Qualified Opportunity Fund, as we alluded to earlier, it can be any corporation or partnership, including an LLC, but the LLC has to be taxable as a corporation or partnership for federal income tax purposes. It cannot be a disregarded entity. A pre-existing entity can elect to be a Qualified Opportunity Fund, but it will need to modify its organizational documents to, reflect that its purpose is to invest in Qualified Opportunity Zone property. The IRS has issued a form, it's 8996, that entities must file with the IRS in order to make the election to be treated as a Qualified Opportunity Fund. The election can be made to be effective as of a particular month. The other requirement in order to be a Qualified Opportunity Fund is that you have to have a purpose of holding Qualified Opportunity Zone property, and this includes holding at least 90% of the assets in Qualified Opportunity Zone property. And this will be tested each year at the end of the first 6 months and at the end of the year. Joseph, I'm going to turn it over to you.
Great. Thank you. Before I start talking about Qualified Opportunity Zone property, I just want to make a couple of points. One, about Qualified Opportunity Funds. The word fund is in the term Qualified Opportunity Fund, but these don't necessarily have to be kind of investment funds in the kind of colloquial sense. There's no magic to these entities. They're just corporations or partnerships. They file an election, and they have to, meet the various asset and activity requirements under the code. So they're very flexible, and they work very well for single project use. They can also be used in kind of the broader investment fund sense, multiple investors coming in and out, the fund investing in multiple projects. But there are actually some issues under the current rules and guidance that we have with doing that. I think taxpayers expect that we'll get favorable guidance that addresses some of those issues, and you do see those funds being set up and promoted. But there is a lot of flexibility with these, and certainly it worked very well on kind of a small, investment by investment approach. The second thing I wanted to address is, as Kelly was discussing, an investor needs to hold their interest in a fund for an extended period of time in order to get the full benefits. And if they dispose of their equity interest, then the benefits terminate. And there's an open question as to where you have a Qualified Opportunity Fund that's set up as an LLC, a partnership for tax purposes, that owns real estate with debt, and at some point in the life of the fund, the debt's refinanced, you have excess refinance proceeds, and you distribute those out to the members of the LLC, which is a common scenario in real estate investments, would that investment somehow be characterized as a return of equity or disposition of equity for the qualified opportunity zone purposes, and somehow interfere with your qualified opportunity zone benefits? That's an open question. It's not clear, and it's certainly something Treasury is aware of, and guidance on that question is expected. So I'm going to turn now to qualified opportunity zone property. Recall, the Qualified Opportunity Fund has to hold 90% of its assets as qualified opportunity zone property. So we're getting into some terminology here on this slide, but the concepts are simple. The Qualified Opportunity Fund has two options as to property it can invest in. It can invest in tangible assets directly and hold tangible assets. Those assets then need to meet a bunch of requirements, and the term for those qualifying assets are qualified opportunity zone business property. The other alternative is the Qualified Opportunity Fund can invest in interest in entities that are treated as partnerships or corporations. And those entities need to meet a bunch of requirements. And those entities that satisfy those requirements are qualified opportunity zone businesses. So let's start with qualified opportunity zone business property. What are the requirements if the fund holds tangible property directly? One, it has to be tangible. As I've mentioned, cash doesn't count. So cash is in the 10% assets that don't qualify. The property needs to be used in a trade or business of the fund. What qualifies as a trade or business for this purpose is not clear. This is one of the big outstanding questions that Treasury will almost certainly address. You know, a fund with lots of employees and lots of activities, it may be pretty clear when something qualifies as a trade or business. A fund that, you know, constructs one property and leases it to one tenant under a triple net lease, does that qualify as a trade or business? That's not at all clear, but it is something we're expecting guidance from Treasury on. And there's a hope that this definition for this purpose will be, you know, very broad and encompass, you know, a wide range of activities. Whether it will encompass a single triple net lease is not clear, but the activities of the entity need to be kind of itself a separate, you know, a trade or business. So the entity needs to have its own books and records and be dealing at arm's length with other other entities. The property needs to be acquired by the fund after 2017 from an unrelated person in a taxable purchase. So relation, you know, for this purpose is tested at a 20% common ownership. So if there's more than 20% common ownership, the people are related. And this creates an issue where property in a zone is acquired by a potential investor in advance of setting up a qualified opportunity fund. We'll talk more about that in a bit. The original use of the property in the zone must commence with the fund, or the fund must substantially improve the property. So where you have a fund that goes and buys an existing building in a zone, it needs to substantially improve the property in order for it to be qualifying property. Substantial improvement means that, you know, generally you have to incur over a 30-month period an amount of capital expenditures equal to the cost of the property, just generally. There was an open question before the proposed regulations as to what happens when a fund buys a building on land in a zone. Does it have to incur expenses equal to what it paid for the building and land together, or does it have to incur capital expenditures equal to what it paid for the building? The proposed regs and a related ruling came out favorably for taxpayers and said it's just the amount paid for the building, which is illustrated here in illustration 2. And no improvement is required with respect to the land. Open questions: what does this mean if the Qualified Opportunity Fund just goes and buys land in a zone? Is there any substantial improvement requirement there? It's not clear. That's an open question. I'd be hesitant to extend the rationale of the ruling and this proposed reg to say that no investments required if only land is acquired in a qualified opportunity zone, but guidance on that question is expected. And during substantially all of the fund's holding period for the property, substantially all the use of the property must be in a zone. So this gives you a flavor of some of the complexity in these qualified opportunity zone rules. We have a double use of substantial here. Substantial is used throughout these rules, and we don't know what substantially all means in either case, and Treasury is kind of scratching its head a bit too and asking for comments on what this means. If your project, your assets is a real estate project, then it's pretty clear, regardless of what substantially all means. The use of the property is in the zone, and that's pretty clear in most cases. If you have an operating business and you have activities in and out of the zone, property may be, some of your properties moving within and out of the zone, then this becomes a much bigger question, and you need more guidance as to how to apply it. So those are the general requirements for qualified opportunity zone business property. This slide just kind of provides a summary of those requirements all in one place, so you can see them all there. So the other alternative for a fund is to invest in an entity that's referred to as a qualified opportunity zone business. So what are the requirements for a business? One, substantially all of the tangible assets owned or leased by the entity must be qualified opportunity zone business property. So we know what qualified opportunity zone business property is. It's property that meets all those other requirements, acquired after 2017, original use in the zone by the entity, or substantially improved. We're just applying all those requirements at the qualified opportunity zone business level rather than the fund level for purposes of this test. But it's interesting that this test is similar to the test that applies at the fund level, but there are material differences. It's substantially all of the tangible assets that need to be qualified opportunity zone business property. For this purpose, the proposed regulations define substantially all as 70%. That's much lower than the 90% requirement at the fund level. So it's intended to provide taxpayers with structuring opportunities to provide them with more flexibility as to the asset mix. And further, it's substantially all of the tangible assets that are owned or leased. So if your tangible assets are less than 100% of your assets, 70% of those tangible assets need to be business property. So again, further flexibility for the taxpayer. But interestingly, this test refers to property it applies to property owned or leased by the entity. So we have this new concept of leased property. What does it mean that a leased property needs to be qualified opportunity zone business property, right? Property that was acquired by the entity after 2017, original use in the zone by the entity, or it's substantially improved. It's not at all clear how to apply these rules to leased property, and so that's one of the open, questions that we're expecting guidance from Treasury on. Then, in addition to that test, there are a number of tests that are special for qualified opportunity zone businesses, and apply only if the assets are being held through one of those subsidiaries. One is this gross income test. At least 50% of the gross income of the entity must be derived from the active conduct of a trade or business in the zone. Well, now, as you recall, a fund has to be engaged in the conduct of a trade or business, and now the subsidiary has to be involved in the active conduct of a trade or business. So what does that mean? It seems to be a higher standard than just involved in a trade or business, but again, we don't really understand what these terms mean, and we need further guidance on them. The intangible property test: a substantial portion of the intangible property of the business must be used in the active conduct of a trade or business in the qualified opportunity zone. Again, what does substantial portion mean? It's not entirely clear how to apply this test to determine what portion of an intangible property is used in or out of the zone. If you're talking about a real estate project, again, application of this is pretty straightforward and wouldn't be an issue in most cases. But if you're talking about an operating business, then with intangible property, how to determine what's being used in the zone or outside of the zone, becomes more of a question that we need guidance on. In the non-qualified financial property test, this test generally requires that less than 5% of the average, I'll say less than 5% of the non-qualified, of the assets of the entity can be non-qualified financial property. And this, includes cash, stock of corporations, interest in partnerships, securities, investment type assets, but it excludes, just accounts receivable and reasonable amounts of working capital held in cash equivalents, or certain debt instruments. So it's important, if you are utilizing a structure with a qualified opportunity zone business, even though you have more flexibility, you have a 70% threshold as far as property that needs to qualify as qualified opportunity zone business property. You need to be careful with your cash and make sure that you don't run afoul of this test.
Yeah, and I would point out, Joseph, when you're thinking about this test, I mean, to the extent that you have reserve or other similar requirements maybe imposed by lenders or other parties, that you need to consider how much the reserves can be, and how they relate to these rules, and hopefully there will be more guidance on this front, but making sure that the reserves don't run afoul of these rules will be an important consideration.
Right. Thanks, Kelly. So another requirement is that the activities of the qualified opportunity zone business can't be one of these disqualified businesses. So commercial golf course, country club. Usually this is, obviously it's not an issue in most transactions, but it's important to be aware of it. So those are the requirements for qualified opportunity zone businesses. I have this slide here, which kind of, lays out these requirements, kind of contrasts, the requirements at the fund level versus the business level. It's interesting, the different requirements that apply at these levels, and it does provide flexibility for taxpayers to decide, if they're setting up a qualified opportunity fund, whether to take advantage of the rules that apply at the qualified opportunity zone business level and set up their structure to have a subsidiary entity that holds the property and the activities, and therefore take advantage of some of the flexibility, that's in those rules. But in some cases, those rules may be more restrictive. For instance, with the additional tests that apply, the reference to leased property. So it's important to look at the particular facts of each situation and to think about how these rules apply differently at the fund level and the business level to see what's the most appropriate structure for any given situation. So I wanted to address a couple of kind of common questions. One, can a taxpayer who already owns land in a qualified opportunity zone make a qualified opportunity fund invest in the property? So the issue is that the fund must acquire the property by purchase from an unrelated person in order for the property to qualify as qualified opportunity zone business property. So if you have this situation, there are a number of things, options you should consider with varying levels of uncertainty associated with them. But under the rules, it seems that there are options that at least should be thoroughly discussed and considered with the tax advisor. The one is pretty straightforward. If the investor owns less than 20% interest in the fund, or does not own more than 20% interest, then the fund isn't related to the investor for purposes of these rules, and the investor could sell the land to the fund in a taxable transaction. Second option, you say, well, the investor wants to own more than 20% of the fund. Depending on how the value of the land, compared to the project the fund's going to be engaged in, it may not be a problem for it to be considered kind of non-qualifying property. You have a 10% cushion at the fund level. And so if the value of the land is relatively small, then this may not be a problem. And if you do the transaction at the subsidiary level, you have even more of a cushion. So that's something that to be considered. Another alternative is to have the investor lease the land to the fund, and then the fund to develop property on the land. As I mentioned, how these rules apply to lease property, it's not entirely clear, but we're expecting guidance, and there's no reference to lease property in the fund, in the requirements at the fund level. So it's just something to consider and talk through with your tax advisor, the possibility of using this alternative. And the final alternative I want to talk about, if the property is held through a tax partnership or corporation that has acquired the property after 2017, under current guidance, it appears possible for that entity to elect to be a fund itself or to be a qualified opportunity zone business in which a new qualified opportunity fund invest. So it's that latter alternative that's shown here. It's illustrated on the slides, and the entity would otherwise be required to satisfy all of the requirements applicable to funds or businesses. So there are alternatives that could be considered. These don't work in every circumstance, but it's something to talk through with your tax advisor. So another important question that was addressed by the proposed regs, what happens if you invest cash in a qualified opportunities fund, but the fund has to hold it for a while and doesn't deploy it before it hits its 90% testing date? As you recall, the fund has to hold 90% of its assets in qualifying property, and that's tested at the 6-month point and the final day of the taxable year of the fund. No flexibility is provided in the code for kind of a grace period for kind of getting rid of too much cash that would cause a problem. The proposed regs address this issue, but they did it at the subsidiary level. They didn't provide any flexibility for the fund itself, but at the subsidiary level, they said that this cash would be considered reasonable working capital if it was designated in a written schedule for the acquisition, construction, or substantial improvement of property within 31 months, and it was actually used in a manner substantially consistent with the schedule. So this is a helpful guidance for taxpayers. It's a little curious that it requires use of a subsidiary, but that's the way Treasury decided to address it. They have solicited comments as to whether similar flexibility should be provided at the fund level, and so future guidance may, provide for alternative structuring. But currently, if you're going to be holding cash for an extended period of time, that in order to avoid penalties, you need to use this subsidiary structure. So this brings us to the end of our prepared presentation. Before we move on to participant questions, I'll turn it back over to Kayla Allen for a few words.
At this time, we welcome your questions. You can type your question into the private Q&A box on your screen, as all phone lines will remain muted. This is a private one-to-one communication, so other guests do not see the question that you're posing or your name associated with the question.
So we have a lot of questions in the queue. We'll get to what we can, and I'll take the first question. Lots of this depends on the performance of the Qualified Opportunity Fund. If the fund loses some or all the investment, can the loss be written off? And that's a good point. A lot of tax benefits that are provided, tax incentives under the Federal Internal Revenue Code, tax credits and such, investors come in and expect basically to get the value of the tax credits, and not so concerned about appreciation and value of the project, where here a big component of the benefit is reliant on the project appreciating substantially over the investor's holding period, and then the investor being able to get the benefit of that appreciation without incurring tax. So can you take a loss on the investment? So recall that an investor in a fund has deferred capital gain and rolled it into the fund, right? And that gain at the latest can be deferred until 2026. When the when that date hits, the investor pays tax on the gain that hasn't been eliminated, and steps up their tax basis to that amount. So they do have tax basis in their investment. What about a situation where at that point, 2026, the value of the fund is their investment is less than what they put in, what they rolled over? The rules provide that you will, in that case, you're not going to recognize all of the deferred gain, but you're capped at what the value of your investment is at that time. So if it's lost value, you'll actually only pick up kind of deferred gain up to that value. Once you get past that date, you have basis in your interest. So when you finally dispose of your interest, if you don't have additional appreciation in that interest, but actually have a loss, then you'd be able to claim that loss.
I'll take the next question. So what is the penalty if a qualified opportunity fund fails to satisfy the qualified opportunity zone requirements? The proposed regs provide that the qualified opportunity fund is subject to a penalty for each month that the requirements are failed to be met. And the penalty is equal to the product of the excess of 90% of its assets over the qualified opportunity zone business property of the fund and the applicable IRS underpayment rate. But there is an out such that a penalty won't apply if the failure is due to quote unquote reasonable cause.
Thanks, Kelly. Another question, can a promote interest in a qualified opportunity fund qualify for qualified opportunity fund benefits? So I guess this is a situation where you have a developer that has an interest that, depending on what the eventually sale price is for the property, and the return on that the other investors get in their investment, their interest might increase as the sale in the eventual proceeds from disposition as the sale price increases. So this is a question. In order to qualify for the benefits, an interest in the fund needs to be acquired for cash, and so there's a question as to you got to consider whether the interest is being acquired for cash or for services, and so that's kind of an outstanding issue and not entirely clear.
We have a question as to whether a qualified opportunity fund can have business activities outside of the zone. So, as Joseph went through in his slides, there are, very strict requirements for the use of property within a qualified opportunity zone. So at this point, without additional guidance, I think consideration should be given to, conducting outside activities of a fund, through a separate entity and not putting those activities in the fund itself.
Okay. See, on substantial improvement test is the basis for comparison cost or value allocation. How is building land value allocation determined? Can demolition costs be included as a substantial substantial improvement. Well, it is correct that it's the tax basis that you're really looking at for purposes of the substantial improvement test. I refer to it as cost because generally what you have is a building that's acquired, and then you start activity on it. And so, but what you need to do is you have a 30-month period, and you have to look at the cost base, the tax basis at the beginning of that 30-month period, and you have to incur costs during the 30-month period equal to the tax basis. Now, the question as to whether demolition costs can be included, that's a question. I don't know the answer to that off the top of my head.
We have a question about what third-party investors will be looking for in qualified opportunity zone investments. I think that's $1 million question. You know, I think at this point, I'm seeing people looking more at real estate investments rather than operating business investments. I think part of that is a function of, you know, potentially people thinking that more guidance is necessary on the operating business side in order, you know, to effectively structure those investments. You know, I think notwithstanding the tax benefits, investors are looking for investments, you know, with reasonable rates of return that, you know, pencil out in addition to the tax benefits. You know, people are looking at their investments through the lens of a 10-year hold period, so looking at investments that make sense over a 10-year horizon. And really, you know, which zones, which opportunity zones and investments, you know, are attractive on a risk-adjusted basis. So, I mean, I think people are looking at it in terms of, you know, how they would look at any other investment, and I think that the tax benefits, you know, just help in that, from that perspective.
So another question, how long does the opportunity zone last? Is there expiration of the program? Yes, there are kind of limits. A couple of limits are important. You know, one, in order to make a qualified opportunity fund investment that qualifies for benefits, you have to have gain that you recognize before the end of 2026. So you really, and so the final kind of qualifying investments will occur halfway through 2027. Now, the designation of these zones as qualified opportunity zones expires in 2028. So this was one of the open questions. What happens if I sell my interest at a time when a zone is no longer a zone? Is that a problem? In the proposed regulations, take the approach of they set a deadline in disposing of the interest, and that's 2047. You have until the end of 2047 to dispose of your interest to get benefits, but if you hold it beyond that, then under the current proposed regulations, you wouldn't be entitled to any benefits. Well, we've reached the end of the hour, so you know, I just want to emphasize, if you're considering a qualified opportunity zone transaction, consult with your tax advisor early in the process. We have a lot of questions here, so we will attempt to respond to these questions that we've gotten that we haven't been able to address during the presentation. If you don't get a response, or if you think of other questions after the presentation, please feel free to reach out to me or to Kelly. Our contact information is provided here, and we'd be happy to talk with you further about qualified opportunity zones. But we just thank you again for your participation this afternoon, and I'm going to turn it back over to Kayla for a few final comments.
Thank you. We'd like to thank you for joining us today. We hope that you might also join us for our 2019 Vorys Economic Development Incentive Conference in Columbus, Ohio on February 22nd. Details are available in the links pod at the bottom of your screen as well as on Vorys.com. This concludes our program.